Hello and welcome. Thank you for joining me for the latest episode of the podcast. Today, I am delighted to be welcoming back Billy Burrows to the podcast. Billy joined me back in 2019 to chat about all things to do with annuities. Billy is a highly regarded financial advisor with over 30 years' experience and is frequently asked to share his expertise on television, radio, and in other media channels. Since we last spoke, the annuity landscape has changed significantly. So this time, Billy and I chat about the pros and cons of buying an annuity versus entering pension drawdown to help you decide the best way to provide an income in your retirement. So without further ado, here's Billy to share his vast experience and expertise. Great to see you again, Billy. Great to see you again. And it was a couple of years back since we last spoke, and hasn't the world changed?
Certainly has. A lot's happened since there, and annuities have gone from something that people didn't really take an interest in to something that is really very interesting at the moment.
Yeah. Is it nice to be popular again?
Well, it's just like the old days, and there's never been anything wrong with the concept of annuity and annuitization. The only problem has been the interest rates. I think the easiest way to explain it is, think of an annuity like a mortgage in reverse. You give your money to the insurance company and they'll take a view on how long they expect you to live, and then they'll pay you back your capital with some interest. And if you look back about 18 months, the interest rate was effectively sort of 0.5%. So maybe people were lucky to get their money back. Now the yields have risen, and we'll come on to why they've risen. The yields have risen, so the underlying interest rate is something like sort of 3-4%. And I make the point that the flip side of annuities is drawdown, and where can you invest a drawdown pot and get 4 or 5% return after charges with no risk?
Yeah, well, that's the key concept, of course, isn't it? Without the risk and without the charges. Let's just take this back a step for the people who are listening to this who are going, so annuities, I haven't heard about that before. I know I'm putting money aside in my pension every month, every year. I'm accruing an amount. I realise at some future point I've got to take money out. In the industry, we call that drawdown. Why we can't just call it taking your money out of a pension, I don't know. But we call it drawdown. You're basically starting to withdraw money. But of course, in the old days, when interest rates were higher, we capitalised that annuity, that amount, and we turned it into a guaranteed income for the rest of our lives. Because interest rates, of course, have been so low, and also the death benefits possibly have become much more attractive after pension freedoms. The kind of whole world changed, didn't it? And people just kind of they looked at an annuity as the poor man of the house.
Yeah, there's a lot going on there, and I think it's useful to take a step back, and I'm quite fond of saying there are only two ways of taking money out of your pension pot, and that's after you've taken the tax-free cash. You can either arrange some sort of annuity or some sort of drawdown, and the two things are quite different. An annuity is a form of insurance policy. It ensures that you don't outlive your income, whereas pension drawdown is effectively an investment contract. You invest your money and you take the money out of it. And the real problem in this is a bit of cakeism. People want their cake and eat it. People want, on the one hand, to have a high income. On the other hand, they want to leave money to the kids. And what they don't realise is that there's a really important trade-off. So if we turn the clock back, in the old days, you had to buy an annuity by the age of 75. So most people bought annuities. Then after pension freedoms, most people, their instincts would tell them that they were better off with flexibility, and death benefits. And I guess if I get a bit, not so much stressed, but a bit concerned about this, is that you've probably got a load of people who unknowingly are probably throwing income down the drain because they don't really understand, what they're doing. Intuitively, emotionally, they think annuities are legalized theft, a rip-off. Intuitively, they think that, drawdown is the best thing since sliced bread. But in reality, and especially now that interest rates and bond yields have increased, an annuity is actually a very hard act to beat. Another way of looking at this is what the so-called annuity puzzle. This originates from America, and very simply it says that if annuities are such a good deal, why is it that people don't buy annuities? And the one of the barriers for people not buying annuities is a lot of emotional baggage. So first of all, people are attracted to leaving money to the children. They like the idea of flexibility, and then finally they think that annuities are poor value, whereas nowadays annuities are very good value.
And of course, there's a few things that I think coming on from your words a second ago, which of course is, this choice between drawing your money out through a drawdown pot or purchasing an annuity is actually, that presents it as a binary option, but of course it isn't. You can break it up.
Yeah, it's a good question. On its own, an annuity, is really quite a simple, idea. On its own, drawdown, it shouldn't be terribly complicated. The difficulty is when you're comparing and contrasting the two, because I think it's one of the most difficult decisions in financial planning. And like most situations where you're faced with two choices and you're unsure of what the right option is, then a combination of the two is actually sometimes a better option. And I've always said that if you were a rational person, and I've never met many rational people, if you're a rational person, you'd probably start off in your 60s with your pension pot in some sort of drawdown with flexibility. And then as you get older, you would de-risk by buying annuities so that by the time you reach an older age, you were either fully invested in annuities or you had annuities under your belt. And there's some good sound financial planning reasons for this. The most obvious financial planning reason is that everybody needs income, and having a level of guaranteed income to supplement the state pension and other DB pensions is really sensible. And the other thing is that this is a bit of a technical point, which is one of the paradoxes with drawdown is that the older you get, the greater investment returns you need in order to keep pace with the annuity. But of course, as you get older, you should be taking less investment risk, not more. So in a nutshell, you have two things. You have some emotional behavioural reasons why it makes sense to buy annuities as you get older, and there are some technical reasons why you should do it as well. So the two together produce a very powerful case for buying annuities as you go along.
Yeah. Now, of course, the other kind of argument against annuities is the inflation risk. There is a significant kind of reduction, isn't there, in the initial annuity purchase, income that you'd get from an annuity if you want an inflation-linked annuity.
Yeah, I mean, if you look at the rates, I was looking at them today. So typically, a couple aged 65 and 60 can get £6,000 a year for a joint life 2/3 level annuity. If that was inflation linked, then they would be getting about 3,500, 4,000, depending whether it was fixed interest, fixed increases, or RPI. So with such a discount to start with, it takes a long time to catch up. But I take a slightly different view, and my own personal view is that annuities are really good at delivering level income. They're not so good. They're not such good value when they're producing an increasing income. So it makes sense to think about using as little of your pension pot to buy the most income. So buy a level annuity, and then with the rest of the pension, if you're in real assets in drawdown, the theory is that in the long run, equities are an effective hedge against inflation. So I'm quite relaxed about people buying level annuities, providing that they make other provision. And don't forget, a lot of people have savings they can call back on, later in life if they need to. And finally,
Yeah, and
Peter,
of course the other.
finally with inflation, and this was a point raised by the Pension Policy Institute, is that for a lot of people, certainly people with modest assets, the state pension will make up a great deal of their pension income, and that is inflation linked. So although you may buy a level annuity, it doesn't mean that your retirement income, isn't keeping up with inflation, because the state pension will do that part.
So the other aspect I think that I experience, and I'm sure you experience, Billy, is that our retirees that we work with spend less as they get older. And therefore, they even get to the point when they get to their maybe early 80s and go, we're not going to buy another new car. That this car will now see us out of our driving years. So certain capital expenditure actually falls.
Yes, that's the so-called U-shaped income curve. I do wonder actually whether that's true. A lot of my clients, they do spend less, but I think there's, reality in life is that most people need income and they need as much as they can get. So although the theory says you have the U-shaped income, if you give people income, they've got plenty of things to spend it on. In fact, I've got a number of clients, and they've come to me quite recently and been quite honest about it and saying, I've got all this money for my pension, and I would like to have an annuity because the discipline of getting a regular income means that I don't feel guilty spending it.
The other thing, Billy, I was thinking that it's obviously worth mentioning, and I know you're quite keen on it, is that the standard annuity quotes which are given out, a lot of people can actually benefit from an enhanced annuity.
Yeah. So anybody that is taking prescription medication or has any medical condition can apply for an enhanced annuity. And one of the changes, the big changes in the annuity world over the last, sort of 15 or so years is that nowadays most people are probably getting some sort of personally underwritten annuity, even if it's as basic as postcode. People can get higher annuities simply by being overweight or having high blood pressure, diabetes. So you don't have to have, a serious medical history in order to qualify for an enhanced annuity. So it's dead simple. You want to go and buy an annuity, consult your doctor first.
Yeah,
But
absolutely.
just a final word on the enhanced annuities. A lot of people think they're sort of getting something for nothing, but of course the reason why they're getting a higher income is that quite simply the insurance companies are accelerating the rate at which they pay them their money back because they've got reduced life expectancy. So like most things in life, there's no free lunch. So I often say to people, the good news is we can get you 10% more income. The bad news is that you're not going to live as long as perhaps you should do.
Yeah. So, Billy, I think over the last 10 years, a lot of people have entered into Drawdown and they're having their annual reviews and everything's kind of ticking along. And they've probably seen some reasonable equity growth, depending on where they've been invested, of course. I mean, if they've had a large fixed income quotient in their portfolio, they may not have enjoyed such significant growth. But I wonder how many advisors currently are talking at annual review of let's have a look at an annuity price. Let's have a look at an annuity. Let's consider what as part of your annual review, or if they're running it themselves, get them to if you're listening to this and you're running your own pension pot, you're running your own drawdown, have you considered getting an annuity quote just so that you can see the different options?
That's a really, really good question. Just sort of taking a step back, I'm quite fond of saying now that there are sort of two things happening in retirement. There's lots of technical issues that advisors are familiar with, and there's lots of emotional and behavioural thing, which is really important to clients. And I think one of the difficulties with pension drawdown is what I call the status quo. It's much easier just to carry on, but what's really important, I think, is that people do review their options, and what they need to get their mind around is that if you're running drawdown, if you don't take sufficient income, if you don't take a decent amount of income, then you're sacrificing, you're giving up income that you may not recover in the future. And is that what you really want? Are you knowingly going ahead and draw down without really maximising, your income potential? And I think that's something that isn't discussed enough at, pension drawdown reviews.
Now, if I remember rightly, Billy, your website gives some nice indicative annuity prices so people can come along and have a look. Is that still the case?
Yep, certainly. One of the most popular parts of my website are the best buy tables and the annuity graphs. And I do urge people to look at the charts because it paints a really interesting picture. If we go back to 2016 and the Brexit referendum, where bond yields fell through the floor, annuity rates were at rock bottom. Then fast forward to Liz Truss's mini budget, and bond yields went through the roof. So annuities are up considerably, and there's a useful rule of thumb for every 100 basis points. That means 1% rise in bond yields. So if bond yields went say from 3 to 4%, then we expect annuity rates to increase by 10%. So some simple maths, if 18 months ago bond yields were 0.5%, today they're nearly 4.5%. Somewhere down the line, there's 40-50% increase, in annuity rates. So when I say annuities are a hard act to beat now, I don't think I'm wrong.
So Billy, obviously we've had, as always, masses of pensions rules and legislation changes currently going through as we talk in June 2023. The biggest thing, of course, is the removal of the lifetime allowance. The tax charge has now gone to 0% for the time being until the legislation goes through. But we're informed that once the legislation does go through, the lifetime allowance tax charge will be removed. But of course, really, where's this going to get to with around death benefits? Should pensions be an inheritance tax free pot? What are your thoughts?
Well, I mean, my thoughts are that at the moment, the very generous treatment of death benefits is something that's a bit of an anomaly. And I do wonder, and I'm not the only person, there are other serious commentators who have made the same point. I do wonder if sometime in the future, especially a Labour government, could revisit the very generous tax allowance. So think of somebody who's in drawdown thinking, I'm going to take the minimum income and leave the money to the kids. If there was a significant change in the treatment of the death benefits, then, they would think again. In fact, they would think back in retrospect and wish they'd taken more money out, when they could have done. But we haven't got a crystal ball. But I think, watch this space.
Yeah. Well, we know that I think that some kind of forced income withdrawal, like they have introduced, I think, in Australia, and a lot of these these thoughts move across, don't they, to us? And the idea that the investing in pensions and the generous tax reliefs should all be about mitigating inheritance tax seems to be a bit disjointed thinking, really.
It's how you frame the question, isn't it? And I'm back to my point. I do think people are losing out on valuable income, unknowingly, or without realizing what they're doing. But that's something that we're not going to change people's minds on very easily, is it?
No. But as long as they get the full facts in front of them and they understand what the choices are, I think that's the most useful thing advisors like ourselves can do for people. And especially as that now, they should be an absolute consideration on most people's annual review.
Yep, I couldn't agree more.
So, Billy, where can people find out more about you and the website and come along and find out more about what an annuity could provide for them?
Well, if you go and have a look at www.williamburrows.com, you've got all the information you need about annuities.
Fantastic. And even if they don't pick up the phone to you, take along that information to their advisor, and remember, impaired life annuities definitely should be a consideration. You can often see significant uplifts if you've even suffering only minor ill health, or as Billy pointed out, maybe even just your postcode could obtain you a better annuity price. Billy, thanks so much for your time today. It's been fantastic. It's great that we can get this back on the agenda for everyone to consider and to become more informed about annuities again.
Great. No, thank you very much.
Thanks once again to Billy Burrows for joining me today. I am sure it has been food for thought, and I hope you have a clearer idea as to which option may be best for your retirement. As ever, if you've enjoyed this episode, please do leave us a review on Apple Podcasts, as it really does help more people like you find us. And for more interviews and retirement planning videos, you might want to check out my YouTube channel. Just search for Justin_King or click the link in our show notes, which will take you directly to my channel. If you want to get in touch with feedback or guest ideas, you can reach me on hello@theretirementcafe.co.uk. So until next time, I'm Justin King, helping you feel more informed in your retirement.